Welcome to the Deep Dive. We're here to cut through the noise and give you the essential intelligence you need for investing. Today, we're tackling a really big story in the Turkish auto sector. Tofaş Türk Otomobil Fabrikası. We're going deep into their 9-month 2025 activity report and financials, the goal, to understand what their huge recent acquisition really means.
And that context, for you, the individual investor, is just critical. These aren't straightforward year-on-year numbers we're looking at. We're dealing with consolidated figures, and importantly, they're inflation-adjusted using TMS 29, the local standard. That's key for getting an accurate picture. But even more than that, the whole narrative really pivots on that massive acquisition of Stellantis Automotive Pazarlama Asia, or SOPAS. That deal closed April 30th, 2025.
Right. And that SOPAS deal basically flipped the script for Tofaş. They went from being primarily a manufacturer to this huge distribution player. So our mission today is to unpack that massive shift. What does it actually mean for the company's financial health, its market position, and, well, its future? And hey, if you find this deep dive valuable, please do like, subscribe, and maybe share this shortcut to knowledge with others you think might benefit. Okay, let's start with the basics. Who exactly is Tofaş? What's their main business?
Well, Tofaş goes way back to 1968. It started as a Turkish-Italian joint venture. Fast forward to today, and it's jointly controlled by two giants, Koç Holding here in Turkey and the global Stellantis Group. Their HQ is in Istanbul, sure, but the real action, the big factory, that's in Bursa, and their core business. It's always been producing, importing, and selling passenger cars and also light commercial vehicles, LCVs.
And that joint control you mentioned, looking at the shareholder structure, end of September 2025, it's really balanced, isn't it?
It really is quite striking. You've got Stellantis Europe SPA with 47.8560%. And then Koç Holding Asia almost exactly mirrors that at 37.6229%. The rest, about 24.3%, that's the public float, listed as Dijer Orta Klar. That shared control, that balance, it provides a certain stability, especially when a company makes such a huge strategic move like this acquisition.
And that move, the SOPAS deal, it didn't just add a little bit to their business, it fundamentally changed their reach in the market.
Oh, completely. After bringing SOPAS under their umbrella, Tofaş now handles the distribution for massive Stellantis brands in Turkey. We're talking Peugeot, Citroën, Opel, DS Automobiles. So yeah, it really consolidated their market power, and their whole ecosystem grew too. They've got subsidiaries like Koç Fiat Credit Finansman A, which, by the way, is changing its name to Koç Stellantis Finansman after this reporting period, and others like Firma Auto, Koç Fiat Sigorta, and now, of course, SOPAS itself.
Now, thinking about who's steering the ship through all this change, there were some shifts in management, right? Levent Çakıroğlu became chairman. I did notice something about the board composition mentioned in the report.
Yes, the report lists 13 board members who served during these 9 months. And it's worth pointing out the gender balance, or maybe the lack thereof. Sylvia Vernetti Blina is the only woman named among those 13 members. So that works out to about 7.7% representation.
And what about the cost of that leadership team? How does executive compensation look?
For the first 9 months of 2025, the report shows senior management compensation hitting about 162.8 million Turkish lira. That was for 28 individuals. Interestingly, that's actually a bit lower than the same period in 2024, which was 167.3 million lira for 32 people. Keep in mind, these are inflation-adjusted numbers in thousands of lira.
Okay, and one last point on people before we move to operations. What about the overall workforce?
Yeah, this is quite telling. Despite this huge expansion in their sales scope because of SOPAS, the total number of employees actually went down year over year. It dropped from about 5,730 down to 4,601. And the report specifies that this reduction was mostly among hourly workers, the production staff. That gives you a pretty clear signal about where the immediate focus shifted right after the acquisition, less on making cars, more on selling them.
Right, so that sets the stage. Big structural changes. Now, how did all this translate into actual operational performance? Did the strategy pay off on the ground?
Well, it's a fascinating picture, almost like two different companies operating under one roof. First, the overall Turkish domestic market for cars and LCVs, it grew, but modestly, about 9.2%. Tofaş's total retail sales, though, they absolutely exploded, up 71.2%, hitting nearly 179,000 units sold. That massive jump is exactly what they aim for with the SOPAS acquisition. It's the Stellantis effect, plain and simple.
Wow, 71% growth. That must have done wonders for their market share.
It certainly did. Their total market share leaped by 14.1 percentage points, landing them at 26.4% of the entire domestic market. Looks like instant dominance.
But hang on, we need to be careful here. That includes all the new brands they just bought, right? What about their original organic performance?
Exactly the right question to ask. If you isolate the impact of those newly acquired Stellantis brands, Tofaş's own, let's call it legacy, market share actually fell. It dropped by 3 percentage points, down to 9.3%. So yes, they bought a huge chunk of the market, but their existing products lost some ground during the same period.
Okay, and that leads us straight into this production paradox we talked about earlier. Sales are booming thanks to the acquisition, but their own factory output is down. How does that work?
It seems counterintuitive, doesn't it? Their total production volume actually shrank by 22.3% compared to the previous year. They produced about 89,400 units versus over 115,000. If you look closer, Egea production was down significantly. The old MCV production line stopped completely, though they did start up production of a new model, the K0, making about 34,600 units.
So they deliberately scaled back manufacturing.
It appears to be a strategic choice, at least in the short term. They seem to be prioritizing integrating the new distribution network and pushing those volumes, even if it means less output from their own Bursa factory for now. It's a trade-off.
The sales figures seem to back that up. You said total volume was up almost 60%?
Yeah, total sales volume up 59.5%. Domestic sales surged 76.9%, clearly reflecting SOPAS kicking in from May onwards. But here's the other side of the coin. Export sales volume actually declined by 4.6% in those 9 months.
So a clear pivot. Focus heavily on the domestic market, leveraging the new brands, even at the expense of exports and immediate production.
Precisely. It's an inward turn to capture and solidify that massive domestic share. But, and this is crucial, they're not just sitting back. They are pouring money into future capabilities.
Yeah.
Capital expenditures, CapEx, in these 9 months hit a staggering 4.889 billion Turkish lira.
Wow, nearly 4.9 billion lira in investment. How does that compare to, say, their profit?
Well, as we'll see shortly, it's actually way more than their net income for the period. It's a huge bet on the future, a massive reinvestment.
And that investment isn't just general upgrades, is it? There's a specific commitment tied to the acquisition.
Yes, exactly. This ties back to the agreement they made with the competition board when the Stellantis deal was approved. Tofaş committed to investing in production for a new multi-energy platform LCV, think electric, hybrid, etc. That production is slated to start in the third quarter of 2026. And the ambition is huge. They're targeting 150,000 units per year of this new LCV by 2027. The goal is to ramp up their total export production capacity significantly, aiming for somewhere between 200,000 and 220,000 units annually by 2027. So this current production dip, you can see it as making space, financially and strategically, for a much bigger manufacturing footprint down the line.
Okay, let's switch gears from units and volumes to the money side, the financial results. This is where we should really see the impact, the cost of that acquisition, right? Starting with revenue or zero.
Revenue is definitely the bright spot on the surface. Total sales revenue surged, up 63.2%, reaching almost 190 billion Turkish lira. And just like with the volumes, the engine for that growth was the domestic market. Domestic sales revenue jumped 83%. But mirroring the operations story, export sales revenue actually decreased by 6.8%. Less volume, less money from exports.
Okay, top line looks impressive, revenue up over 60%, but how did that translate further down the income statement? What about gross profit?
Here's where the picture starts to get complicated. Gross profit actually decreased by 22.4%. It fell from 14.7 billion lira last year to 11.4 billion this year.
Wait, revenue is way up, but gross profit is down. How?
It strongly suggests that either the cost of the goods they sold went up significantly, or perhaps the margins on those newly acquired Stellantis vehicles they're distributing are lower than their traditionally manufactured products, or maybe a mix of both. But the really dramatic number, the one that tells the core story of this period, is the İsas Faaliyet Kârı, the core operating profit.
Okay, core operating profit. What happened there? This strips out financing and taxes, right? Just the profit from the main business operations.
Exactly, and this is where the impact hits hardest. Tofaş went from a healthy operating profit of nearly 6 billion lira in the first 9 months of 2024 to an operating loss of 482 million lira in the same period of 2025.
A loss. A core operating loss. With revenues up 63%? That doesn't seem right. How did that happen?
It was swallowed whole by operating expenses, specifically the costs associated with integrating SOPAS and pushing those new brands. Marketing and sales expenses, for example, nearly doubled. They shot up to 7.6 billion lira. So you have this massive injection of cash needed for the distribution network, the branding, the sales push, and it completely overwhelmed the gross profit generated by those higher sales. That's the cost of entry, the immediate pain of the acquisition.
Okay, so the bottom line, the net income must have taken a hit to them.
It certainly did. Net income dropped sharply, down 56.3% compared to last year. It came in at 2.930 billion lira, down from 6.7 billion. And that translates directly to earnings per share, of course. It fell from 13.40 kurush per share down to just 5.86 kurush.
Ouch. That's a significant drop for shareholders.
It is. And one more technical point affecting the overall financial picture, even if it's not strictly operational profit. The report also shows about 2.4 billion lira in net losses from cash flow risk hedging, which hit their equity directly. It's just a reminder of the background risk they operate under with foreign currency volatility. It adds another layer of pressure on the financials.
Right, let's pivot to the balance sheet now, because an acquisition this size doesn't just impact profit and loss, it fundamentally reshapes the company's financial structure. What about their cash position?
Well, the cash on hand actually decreased. They ended September with about 18.7 billion lira in cash and equivalents, down from almost 25 billion at the start of the year. Now, their operations did generate good cash flow. About 18.3 billion lira came in from operations, which is much better than last year. But that strong operational cash flow was completely wiped out, and then some, by the cash spent on investing activities. And the main driver there, the Sopies acquisition itself, that alone was a net cash outflow of nearly 12.6 billion lira.
Okay, so cash down because they spent big on the acquisition. That cash had to come from somewhere or be borrowed. What happened to their debt levels?
They shot up significantly. Their net financial debt, that's total financial debt minus cash, almost doubled. It went from around 10.3 billion lira at the end of 2024 up to 19.6 billion lira by the end of September 2025. That's a big jump in borrowing.
Doubled. Wow. And what does that do to their leverage ratios? What does it mean for you, the investor, in terms of risk?
It pushes the risk profile up quite a bit. The key ratio here, net financial debt divided by equity, it jumped from a pretty comfortable 17%. All the way up to 37%. So the company is significantly more leveraged now than it was before the deal. That debt burden is the price they paid for that transformation.
And speaking of equity, that also took a hit, didn't it? Total equity decreased.
Yes, it did. Total equity fell from about 59 billion lira down to roughly 53 billion lira. And that decrease wasn't just from the operating performance or the hedge losses we talked about. There was also a very large dividend payment. Tofaş paid out about 6.8 billion lira in dividends back in April 2025, just before the Sopies deal officially closed. So new debt came on, cash went out for dividends, and equity shrank.
Okay, let's quickly look into the footnotes, the dipnotlar. There were a couple of really big items related directly to the acquisition cost itself. First, goodwill or sharefi. That was a huge number.
It was. Tofaş recorded 7.744 billion lira in temporary goodwill. Now, just to clarify for you what that means, goodwill is basically the amount Tofaş paid for Sopies, over and above the calculated fair value of the actual assets and liabilities they acquired. So that 7.7 billion lira represents the premium Tofaş paid, essentially betting on the future synergistic benefits and profits that integrating Sopies will generate. It sits on the balance sheet as an intangible asset for now.
So they paid a big premium based on future hopes. And there was another interesting payment structure element too, wasn't there? A conditional payment.
That's right. There's a contingent liability noted amounting to about 5.6 billion lira, which is part of the overall transfer price. Think of it like an earnout. Tofaş has to pay this additional amount, but only if the acquired Sopies business achieves certain free cash flow targets over the next 8 years. It's a way to tie part of the payment to actual future performance, but it does represent a potential future cash outflow for Tofaş.
Okay, good to know. And one final detail from the balance sheet notes, they're selling their headquarters.
Yes, a post-reporting period event. They noted the plan to sell their HQ building, finalized in October 2025, for about 1.2 billion lira. On the September balance sheet, it was already classified as held for sale with a book value of around 245 million lira, so that sale will bring in some extra cash after this reporting period ended.
All right, let's wrap this up by looking ahead. Given this period of, frankly, quite a bit of financial pain and major strategic shifts, what are Tofaş's own expectations? How has management revised their outlook?
The revisions to their guidance really hammer home the strategic pivot we've been discussing. They've actually increased their expectation for the total size of the domestic Turkish light vehicle market for the full year. And more importantly, they've significantly boosted their own domestic sales target. They now expect to sell between 350,000 and 370,000 units domestically, up from an earlier forecast of 330K.
So doubling down on the domestic dominance strategy, they feel confident they can hit those higher sales numbers with the new brands integrated. What about the other side, exports and production?
That's where the outlook gets dialed back, confirming the short-term trade-offs. Their export target for the year has been reduced. They now expect to export between 50,000 and 60,000 vehicles, down from 80K. And similarly, the production forecast is also lowered, now targeted between 130,000 and 150,000 units, down from 150 to 160K previously. They're openly acknowledging the near-term pullback on manufacturing and exports to focus on nailing the domestic integration.
But the investment continues to ramp up.
Oh yes, the investment expenditure forecast, the Yatırım Harcamaları Tutarı, gets a significant hike. It's increased from an expected €150 million up to €200 million for the year. So the management outlook is perfectly clear. Secure domestic leadership now, absorb the production dip and the financial hit that comes with integration, and invest aggressively for that bigger manufacturing future they've committed to.
Okay, so let's try and synthesize this whole deep dive for you, our listener. Tofaş successfully executed a massive strategic pivot. They bought market leadership in Turkey through the Tofaş acquisition. You see that clearly in the 71% retail sales jump. But that transformation came at a steep immediate price. It was funded by a lot more debt, leading to higher leverage, and the huge costs of integrating those new brands, especially marketing, completely wiped out their core operating profit for these 9 months, turning it into a loss, even while production volume also contracted.
Yeah, connecting all those dots for you as an investor, this 9M 2025 report really paints a picture of a company right in the thick of a very challenging transition. They are consciously accepting significant short-term financial discomfort, much higher debt, no operating profit for now based on the promise of a much bigger long-term prize. That prize is sustained domestic market dominance, and eventually that significantly expanded LCV production and export capabilities starting around 2027.
So, given that management is clearly comfortable with this short-term hit, even projecting higher leverage and accepting an operating loss to digest Stellantis, here's the final thought we want to leave you with. Tofaş booked 7.7 billion lira in temporary goodwill, essentially a bet on future earnings from this deal. The absolutely crucial question for you is, how quickly can they actually deliver? How fast can Tofaş turn that massive integration effort and that huge paper value of goodwill into real, sustained, tangible operating profit in the quarters ahead? That's the core calculation you need to grapple with when looking at Tofaş right now.